I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
I am Steve Malanga. I'm a senior editor at City Journal here at the Manhattan Institute, and I'm here to welcome you. If you've been here for either or both of the first two panels, you know that they've been sobering, to say the least. In fact, I had to go into my mental thesaurus to find a word, a synonym for gloomy, depressing, and I came up with sobering. But this wouldn't be New York, and this wouldn't be the Manhattan Institute if we didn't try to end on a note of optimism. And that's what we're here to do today. We're here to talk about the future. We're here to talk about opportunity. Because after all, as we've been saying in the City Journal for a long time, New York is the opportunity city. And New York has managed to reinvent itself many times in many different ways. And I'm not just talking about the last 25 years, but I'm talking about the last 400 years. Now, I've been covering New York City for longer than I care to admit. And I can remember after the market crashed in 1987, I can remember shortly after that attending a conference with many of the leading lights in the city at the time, talking about the future of the city. And it was a pretty gloomy conference. The former Regional Bureau of Labor Statistics Commissioner Sam Arenholt was there, and he pointed out that during the 1980s, Wall Street had accounted for something like 70% of the entire economic gain that the city experienced. And that was an enormous problem because the fundamentals on Wall Street had changed, not just because of the decline in the stock market, but because of the essential evaporation of the junk bond market, the indictments of Ivan Boesky and Michael Milken, and a whole series of things along those lines. In addition to what had happened on Wall Street, other people that day pointed out that New York City was not the home to the kind of industries that were growing in America. That indeed, even old standbys like media and entertainment were not growing in New York City. Instead, they were growing in places like Atlanta, where cable television was rising, where there was this new phenomenon called talk radio that really wasn't happening in New York City. So New York wasn't even the home of any expanding industries that were centered really in other places around the country. In addition to that, New York had an enormous crime problem. Crime was reaching historic highs. And so New York also wasn't a place that people wanted to come and visit, or a place that was very livable at that particular time. And at the conference, Hilton Kramer, the noted critic, pointed out that as a result of that, New York City wasn't even a place where people came anymore, where young people came to get involved in the arts. That in fact there was more money in the arts, there was more innovation in the arts, there was more of an attraction in places like San Francisco, San Diego, and Los Angeles, among other places. So it was a pretty gloomy outlook. Now, what did this conference miss? Well, of course, nobody understood that the internet, which had been invented a few years earlier by Al Gore, was in fact going to be this enormous driver of new industries, and that some of that would occur in New York City. No one anticipated the revival of the stock market. No one anticipated the steep declines in crime, which had a dramatic effect on economic development throughout the outer boroughs of New York City and in neighborhoods around the city. An effect which I think some people underestimate in the revival of New York City's economy. So New York City became a very different place. But one thing remained constant, and that is the enormous impact of Wall Street. Now, after the tech bubble burst in 2000, and then again, most especially after 9/11, there was a different sense in New York City, almost a sense of optimism, of resiliency. And I think a lot of that was because of the nature of 9/11. People felt that New York would bounce back. There's a different feeling right now. There's almost a sense, first of all, that what's happened on Wall Street represents a sort of paradigm shift, and that it's not coming back very quickly. In addition to that, there's almost a sense of blame Wall Street, and as a result, blame New York. Those kinds of things I think, are what have contributed to this sort of gloomy outlook that we've heard discussed in the first two sessions. But a couple of things are important to understand. First of all, don't mistake the New York City economy for New York City or New York State budgets. They are somewhat different. We are far more over-reliant from a budgetary point of view than we are from an economic point of view on Wall Street, which is not to say that we're not reliant on Wall Street in the larger economy. But there are other things happening in New York City and have been happening in New York City for a long time. New York City in the 1990s once again became a place of entrepreneurship. And that wasn't necessarily something that was happening on Wall Street. New York City in the 1990s again became a place that people wanted to come to. It again became a livable city. So we're here to talk about some of the advantages of New York City, and also, I think, some of the things that stand in the way of further exploiting other opportunities outside of New York City. We want to talk about other economic opportunities. Maybe we'll even discuss how the city can survive every October without the World Series again. I mean, talk about paradigm shifts. We have a stellar panel here. I'm just going to mention briefly, you can read their bios. I'm sure you already have. But we're going to, I'll mention briefly all four of them, and then so that they can just come up one at a time, and I don't have to interrupt them with long introductions. We have, of course, from Harvard University, one of the leading urban economists in the country, the leading urban economist in the country, Ed Glaeser, who no one has written more about how cities succeed in the 21st century and why some cities can succeed than Ed Glaeser. And, you know, at a time when we have a worldwide liquidity crisis, which has and a shortage of capital, it's important to remember, as I think Ed's probably going to tell you, that in New York City, we have an abundance of the most important kind of capital, which is human capital. We also have Jason Bram, who's been from the Federal Reserve Bank of New York, who's been covering the New York City economy for longer than I can, as long as I can remember. And Jason is really a specialist on what else is growing in New York. Another person we have is one of the most interesting people from the 1990s economy in New York City, and also, I would argue, from the 21st century economy in New York City, Kevin Ryan, who was the chief executive and one of the early entrepreneurs, internet entrepreneurs in New York City, as chief executive of DoubleClick, one of the major growth firms in the 1990s. Now, what's so interesting about Kevin is that after he left DoubleClick and after the technology meltdown of 2000, he didn't leave New York City. He and a lot of other folks stayed. Since then, Kevin has founded count them, six internet companies, which he's helping to operate here in the city based on what's known as the Web 2.0 platform. And he sees New York City still as an entrepreneurial city, and that's one of the reasons we invited him here. And finally, from the Manhattan Institute Center for Rethinking Development, Julia Vitullo-Martin, who's written really extensively on opportunities for growth in New York City, opportunities for new development, and also the way to get government out of the way to help spur that development. So we're going to start with Professor Glaeser and then move right on. Professor Glaeser, go ahead.
Thank you. I'm thrilled to be here. I think I'm never happier than being at an MI event, and certainly never happier than thinking about the future of this great and miraculous city. In 2006, Manhattan had 2 million workers and a payroll of almost $200 billion. Of that, 300,000 of those workers were in finance and insurance. The share of the payroll in finance and insurance was 40%. Within a tiny sliver of finance and insurance, so-called securities, commodity contracts, and related industries, of course, had 28% of this island's payroll, $54 billion, although it employed only 8% of the island's workers. That $54 billion, of course, makes that industry larger than all of Maine, New Hampshire, and Vermont put together in terms of payroll. Given the enormous importance of this industry to the city of New York, it is almost impossible to imagine that the next few years are going to be all that pretty. It is hard to imagine that we will not have tough times in terms of declining real estate prices, in terms of the fiscal problems that we are facing. And all of that short-term pessimism is almost assuredly duly warranted. But that should not lead us to any confusion about the enormous long-run strength of the city, which I think, as Steve just said, is surely because of the remarkable human capital of this place, and is because of the tremendous ability of a dense, packed city like New York to continually reinvent itself and to continually produce new ideas. And as a result, I think my basic message is that while unquestionably no city, no matter how strong, can sail through a maelstrom that hits its primary industry without experiencing some turbulence, that does not mean that there is anything problematic in the long-run model of the city, or that New York will not continue to be one of the dominant places in the economy of in the 21st century. Now, this clarity, or this type of strong statement, I think would have been much harder in, let's say, 2 crises ago, in the crisis of my youth in the city of the 1970s. Right? In the 1970s, when New York was enormously troubled, right? The enormous fiscal crisis that basically put the city into receivership, the decline of hundreds of thousands of garment industry jobs that meant that a city that had once thrived on light industry now seemed to have no future mission. After all, New York had been born on its ability to speed the flow of goods over space. It had been born on its port, built up by its railroads, enlarged by its canals. All those transportation cost advantages seemed almost meaningless in a world in which the death of distance had shrunken transportation costs. And it was possible to have vast numbers of factories in the suburbs or in right-to-work states or in China. All of those things made it hard to see where New York's future was going to lie. I think today we actually know the answer to that. And New York's future is in the production of ideas, not in the production of goods. And that is indeed the central paradox of the 21st century, which is that while you might have thought that the death of distance, the decline of transportation costs, the globalization of the world would mean that proximity was no longer valuable, would mean that density was no longer such a critical ingredient to success, in fact, the opposite has occurred. That, in fact, cities have been helped by globalization. They've been helped by new technology, in large part because those trends have made it more important to be smart. Because the big effect of globalization and increased changing technologies has been to increase the returns to new ideas, the returns to skill, the returns to knowledge. And cities for millennia have been places where people got smart mostly by hanging around other smart people. Think of Socrates and Plato on an Athenian street corner. Think of Donatello interacting with Brunelleschi. Think of in Chicago, think of William LeBaron Jenney and Louis Sullivan, right? Smart people learning from each other, borrowing ideas, creating chains of innovation, which were the wellsprings of urban growth. Those chains of innovation have gotten more and more valuable than ever. And while the competition with Japanese goods producers have been nothing but difficulty for the goods producers of Detroit, the ability to access Japanese markets, the ability to direct finance throughout the world, the ability to look for arbitrage opportunities or new product opportunities anywhere in the globe has been nothing but a boon for the idea producers of New York. And of course, the essence of this is really that cities are machines for making our species more productive. We are an enormously social species. We learn from people around us. Almost everything that we know comes from borrowing or stealing or learning or imitating or some other connection with the people around us. And it's because cities have this remarkable density of learning that cities remain so vibrant. There's an enormous amount of statistics which backs up the kind of thing that I've been talking about, right? One of the facts that goes along with New York's success is the enormous success of skilled cities over the past 30 years. If you want to predict which one of the colder, older cities have done poorly and which ones have done well, the share of the population with college degrees in 1970 does a remarkable job explaining that, in part because the share of populations with college degrees in 1970 predicts the increase in the share of the population with college degrees since then. Smart people have flocked to be around other smart people. There's also been a remarkably stronger link over time between being around skilled people and being around skilled people in dense places and how much you earn and how high your payroll is. There's a strong connection between skills and density and innovations as measured by patents. The patent flow, by the way, shows us the links that are so important across space. Patents cite patents that are physically proximate to one another. New York's role in the 21st century is particularly maintained by the fact that it is a gateway city, and it has always been a gateway city. Our dominant 19th century industries, sugar refining, the garment trade, publishing, all came out of our role as the country's greatest port. For 2 centuries, we have been the dominant place where America connects through the world. Those connections through the world are more important than ever. And New York does better to think of itself as a partner with London, a partner with Hong Kong, a partner with Tokyo, than it does as a competitor with it. That New York is part of a node where smart people interact with each other that facilitates the face-to-face contacts across space that I think are not likely to be made irrelevant through the internet anytime soon. The reinvention of the 1970s, I think, very much shows this power of proximity, right? In fact, during those dark years of the 1970s, the reinvention that gave us the Wall Street booms of the past 25 years was already going on. New ideas about thinking about risk and return came out of academia, came out of the University of Chicago in some cases, and sometimes from Boston. They moved to Wall Street embodied in people like Jack Traynor, who came to Merrill Lynch in 1966 with his ideas. Those ideas of trading off risk and return then led the young Mike Milken to think about how you could sell higher risk securities. Milken's idea then moved its way to Henry Kravis, who then thinks about how to use higher risk securities to change the structure of American industry. The ideas of trading off risk and return make it possible for Louis Ranieri to sell mortgage-backed securities. A greater need for data makes it possible for Mike Bloomberg to move from running the trading floor of Salomon Brothers to selling information in this information-rich city. Stories like that occur throughout New York City and occur in many other large cities over the past 30 years, where smart people were able to reinvent those urban areas. And I have no doubt that, first of all, that Wall Street in some form or other will come back, but I also believe that in the next 30 or 40 years, new ideas, new innovations, new industries will come up that we have no idea about. I always love the statement that 40 years ago, my predecessors at Harvard made the statement that unless the candy industry was bolstered in Cambridge, lest you forget, Cambridge was the big center of the New England Confectionery Company, that's Necco wafers and other things. Cambridge was dead. Nothing would ever happen to Cambridge unless the government stepped in and subsidized this industry. Of course, the Necco factory is now a biotech, now houses a biotech concern. Right? The unpredictability is the heart of this stuff. I mean, if the ideas were obvious, then entrepreneurs wouldn't be motivated to actually come up with new ideas and make fortunes while doing so. The government can't micromanage this stuff. And I think one of the worst things that could come out of this was the idea that we could, in some top-down sense, figure out what New York is going to do 20 years from now. The glory of New York is we don't know. We just don't know, and that smart people will figure it out. This, of course, does not mean that there isn't a major role for government. And I think Mayor Bloomberg correctly understands that one of the worst things that happened in the 1970s was that we forgot about quality of life in the city, that we decided to respond to fiscal crisis by letting crime go up and by not investing in the city. Obviously, the crucial ingredient to reinvention is that smart people want to continue to live and work in this city. And we need desperately to make sure that we make the quality of life investments, which means, by and large, good schools, safe streets, relatively fast commutes, a plea for congestion pricing, and of course, lower taxes. Right? All of these things, which are the basics of good government, are not just about being in some sense responsible, but it's about the fundamental economic future of this city, because people are mobile, and while this density is magic, there are other dense places. The second. The last point that I want to make on just the future of this is I just want to echo Paul Romer's words that were already listed here, that a crisis is a terrible thing to waste, right? We've enabled government, we've let government get very fat, we've enabled an enormous number of crazy policies to persist in the city because of the magic of Wall Street, because of those smart people teaching each other, gunning an industry that was able to make us survive despite rent control, despite enormously wasteful provision of services, despite a crazy zoning system that makes it impossible to change. This is a great time for us to rethink those policies, and particularly to rethink those rules that make change difficult, right? That the necessary ingredient for smart people to innovate in smart ways that change New York and change the world is that they not be hampered by rules that make it impossible for them to act. I'm deeply disturbed by all these calls for new regulation. Certainly there is a need for certain types of new regulation in Wall Street. Certainly there are some reforms that are needed. But the right answer to what's happened is not that suddenly we move towards some highly regulated European-style economy that stifles entrepreneurship and makes innovation possible. Exactly the opposite is true. It is through free men and free markets innovating and collaborating with each other in cities that, in fact, this city and this country will come back. And let me end there.
Hi. Okay, I'm going to try to keep this fairly quick because nobody wants to listen to an economist for more than 7 or 8 minutes. So, and it's a privilege talking after Ed because a lot of the optimism he has about the future, I think, is right on the mark. I've lived through, as many of you have, I've lived through many, or at least a few downturns in New York City, and each time that there's a steep downturn, there's this sort of sense that this is it, and things are never going to come back. And then during the height of the booms, of course, there's a sense this is it, and we're never going to have a downturn again. So sometimes it's good to be a little bit contrarian. First, let me start out the views I express are mine and not those of the Federal Reserve Bank of New York or the Federal Reserve System. I'm going to pretty much just give you a quick overview of the economy, sort of a backward-looking overview, because I think it's useful to learn from history. I think Ed gave a pretty good forward-looking thing, so I can sort of dodge that. I should announce right now that this morning the Federal Reserve Bank of New York announced, I knew that would get everyone's attention, but it's really not that big a deal. But it just happens that we came out with, we just published an overview of the regional economy. It originally was called a mid-year review, and it was supposed to come out in July or August, and then there was all this turmoil, so we had to keep tweaking it, and then in October we decided maybe mid-year review wasn't a good title, so it's just called a review. But we have a few copies out front, and it's on the web if anyone's interested. But these charts are not from that report, but it still might be something you'd be interested in. Okay, so I'm going to start out very briefly. We have an index of coincident economic indicators that we put together. It's sort of a smoothed way of combining employment and unemployment, a measure of personal income, and the work week. And we do it for New York, New Jersey, and New York City. And then the U.S. figure is not exactly comparable. It's based as the Conference Board Index of Coincident Indicators. But it's good to get a rough sense of how things are doing. And what's really striking, and it's largely because of the income growth, is that New York City, as you can see, first to go back to the 70s, you can see what a rough period we had. And you can see that each of the last 2 downturns were pretty severe in New York City. But I think what this underscores is that New York City is a very boom and bust economy. We have big booms, we have big busts, and sort of underscores what I mentioned before. New York and New Jersey seem to be kind of leveling off in terms of, or declining a little in terms of growth. But New York City is going into this mess, or whatever you want to call it, in a pretty strong position. That is, if even as of today, and I'll get into job numbers in a sec, things are looking good so far. Just very quickly, this is the Philadelphia Fed puts out these coincident indexes for all 50 states. And this is what it looked like at the end of last year. The red and blue states, I know it's an election year, it has nothing to do with that. But they just happen to use red and blue. And you can see most of the country is blue, which means growing, and especially New Jersey and New York and much of the Northeast. And this is what it looks like as of August. They probably, with my luck, they probably this morning just released September. But basically the country is largely red, especially the Midwest and the West. But you can see New York is still blue. This is just a sort of an overview of year-over-year job growth. New York City, you can see, is way above not only the national average for the last couple of years, but well above just the region as a whole. And we have Newark in there. Why do we have Newark in there? I guess it's because I knew EJ was going to say that that New Jersey's doing even worse than us, so I just wanted to put some numbers to that. But I think it's important to note that New York City's economy, even as of, this is up through, I'm not sure if it's August or September, but the numbers, private sector job growth, it's really quite remarkable. They're still up, and I'll get into more of that in a sec. This is actually one of my favorite graphs. Everybody knows the securities industry is a driving force behind New York City's economy, but what we did in a study a few years ago was just kind of plot securities industry employment with everything else in New York City employment, excluding securities, which is the red line. And I won't go into each cycle, but you can see that in virtually all the turning points, both ups and downs, turns in securities industry employment precede turns in everything else. And you can see that what's going on now obviously doesn't bode well for the rest of the economy. And here, this is just a quick glimpse based on the latest monthly employment numbers. And what I did was I took this is based on the percent decline in employment that we've seen over the last 12 months. And rock bottom, you can see securities, also things related to that, some of the other financial sectors, but also certain aspects of retailing, publishing, and so forth. But really, the bulk of the decline is in securities. And in terms of sheer number of jobs lost, it really just obviously stands out. It's really the weak sector. It had been the strong sector driving New York City's economy. You know, and at some point in the future, people said, "Well, what do you expect?" I was at another conference. People said, "What do you expect to turn up before the rest of what industries you expect to fuel growth when New York City finally does turn around?" So I said, well, based on that last graph before, the securities industry. And people were like, but that's after probably a pretty steep decline. So this is what it looks like now in terms of net job loss. But I was instructed to be a little more optimistic. So that's why I did the declines first. There are actually a lot of industries that have been growing over the past 12 months. I guess the caveat is that all these numbers are subject to revisions. They benchmark revise the numbers. They don't always get it right the first time, especially when you're going into a downturn. But you're still talking about pretty strong growth in a lot of industries ranging from restaurants, architectural, engineering firms. I mean, you can see for yourself. I guess we can make this presentation available, so I don't want people writing down things. And it's on the BLS, the New York Labor's website. Now, it's important to keep in mind that the securities industry is also the highest paying industry. And when you have big job losses in a high paying industry, that really has a substantial effect on the fiscal situation, which we've heard all about. But also, and a lot of these industries are mixed. I mean, a lot of these are low-paying industries. You have things like child daycare services, full-service restaurants. But it's important to keep in mind that one of the things when recession happens from a fiscal point of view, you want the high-income industries to be doing well. But on the other hand, a lot of these lower-paying industries employ some of the more vulnerable people. So I don't think it's necessarily a bad thing that you have a lot of these industries growing. I mean, obviously, it's not a bad thing. And then this is just with the sheer net job gain as opposed to percent growth. And because restaurants are such a big employer, it really, really stands out. What I find weird is and I can't imagine this won't be revised now, is real estate rental and leasing. It still seems to be a big growth sector. If anyone has any ideas, maybe when we get into the discussion part, we can talk about that. And just very quickly, I threw these in because I think the housing market is a very interesting thing. There's been a big pullback. This is just annual housing permits, and it doesn't even include this year because this year there was a lot of weird stuff going on with changes in the building codes, and New York would kind of be off the charts up. But even up through 2007, there's been a big pullback by developers, just in residential construction. But in New York City, there's still a lot of stuff in the pipeline. And obviously recently, I think it's sort of sunk in that maybe real estate speculators, investors, developers might want to be a little more cautious. But the point is, even compared to the 80s, there's just an awful lot of stuff. A lot of it's in the outer boroughs, but a lot of it's in Manhattan. You walk around, you kind of see it. And then just one more indicator, the office market is also starting to weaken. This goes up to the third quarter. Just another sign, that just because employment is up from a year ago, I don't need to tell you that, the outlook is not all that bright for New York City. But again, I think it's important to keep one eye on the long term, and I just, I don't have to say it because I think Ed Glaeser said it better than anyone. That pretty much does it. Thanks.
All right, thank you. I'm almost always the most bullish person in the room, so you should just, fair warning, you should be prepared for that. But actually, I'm Kevin Ryan, and speaking primarily for the internet sector and for startups in New York City, the last 10 years have been extraordinarily successful, and I think even better than most people think. So let me give you the context for that. I've had two big waves of involvement. In '96, we started DoubleClick. We had a few people. 4 years later, we had 2,000 people. We were in 35 countries. 2/3 of that was just internal growth. I had 27 full-time recruiters hiring. We hired, at peak, we hired 400 people in one quarter. All of that is what I refer to as the good old days. There was a little, let's call it a blip, but other people might have called it a cataclysmic crash from 2000 to 2003. And unfortunately, we were hit worse than most people because we were a provider. DoubleClick is a provider to internet companies. So we had clients, like the large companies you've heard of, as well as the petfood.coms of the world. And so 70% of our clients went bankrupt. And that was the less good time. And I took the company from 2,000 people down to 1,000 people. The stock price went down 90+%, like everything else. I turned over the entire management team. It was an ugly time. And coming out of that, by 2005, what we were left with was we'd lost 70% of our clients. We had lost 80% of our competitors. And so came out of it with actually an enormously profitable business that ultimately, a year or two later, was sold to Google for a little over $3 billion, has 35% profit margins today, does hundreds of millions of dollars. So, but what I want to compare is the period of 96, 97, 98, which was launching a company here. And then, so starting in 2005, the CTO of DoubleClick and myself decided we thought there were great opportunities starting companies. So we've since started 6 companies. In the last 3 years, we have 175 people. Last year, between the companies, we did about $7 million in revenue. This year, we're going to do about $50 million in revenue. As of this month, we're at a $70 million run rate between the companies. And at least one of them hasn't even launched yet, so has no revenues at all. So there are absolutely opportunities out there. The only other thing I'm involved with is the Ladders. It's a job site here in New York. Started 4.5 years ago, had no revenues. This month crosses a $100 million run rate, has 250 people, all in New York City. So there are big, big opportunities. The thing I would compare is in 97, when I went out and was raising money, there were almost no VC firms in this area that had any experience. I couldn't find, and this is hard to believe for all of you, we needed a lawyer to go public. Now, New York City, finding a lawyer, you'd say, no problem. There was almost no one in New York who had taken a company public at that point. They were all out in San Francisco. I couldn't find anyone who had worked for a startup before. Obviously, no one had internet experience. The internet wasn't very big at that point. And I compare all of that to now. So I was at a technology meetup, which is a session that happens every month. A lot of tech people in New York City. 400 people come every month to hear about new startup ideas. So last time I was presenting one of my companies, I said, how many people here have worked for a startup before? And 2/3 of the room had startup experience in a previous startup, and now we're doing it again and staying here. So in 1996, 1997, when you compare to Silicon Valley, the number one thing that I heard was, why are you here? Why are you not in Boston? So now people even laugh at the idea that you'd want to do a digital media startup in Boston as opposed to New York, because New York must be 4 or 5 times larger now. We don't even consider Boston competition, really. San Francisco certainly is still larger, but to mangle a parallel, Silicon Valley is sort of the United States, and New York is sort of China. It's smaller, but it's growing faster. In 96, there were 8 times as many startups who were funded in Silicon Valley as in New York City. A year ago, there were 3 times as many companies funded in Silicon Valley as in New York City. So that gap is narrowing. It could take 20, 30 years. It may never be the same. The point is, though, that the fundamental growth is extraordinary. And so, why is that? That's because the core elements for the internet industry are things that New York has. It's not a good place probably for the garment industry anymore. But for our industry, we need smart people, and New York has that. Space is actually not a big issue. I hear startups all the time whining about space. The average, because you can cram people in a little bit more here, it's just more acceptable than if you're in Pittsburgh or somewhere else. And rents are higher, but I think of it how much I pay per person. And so in our space right now, we pay about $5,000 per person per year. If you go to Pittsburgh, maybe I'd save $1,000 per person all in. But since the average person's making close to $100,000 all in, that's just not, it doesn't move it. If I had lots of hourly workers who were paid $20,000 a year, that might start to be significant. But for me, it's really not. And at DoubleClick, at one point, we compared across the world and said our main centers were London, New York, San Francisco, Tokyo. At that time, New York had the cheapest real estate. for DoubleClick there. So it's a little bit, obviously would like to have a little bit cheaper, but it's not really a big issue. So we have smart people here. There's plenty of bandwidth. There's a lot more financing, and financing you can get in Boston as well. I actually find there's enough financing. If every company gets financed, by the way, there's a problem. That's the beginning of a bubble. So, lots of companies should not get financed. And so I think there's plenty, at least in my sector, that do. One of my companies is a cloud computing company, which is a super difficult technology infrastructure, technical company. We have already 16 to 20 competitors, all of whom have been funded. This is for a big wave that's coming over the next 10 years, but it's not even here yet. And so it's very risky. So there's been plenty of money out there. It's obviously going to get much more difficult in the next year. But the fundamentals here are very good. Also, we have the clients. So in a lot of sectors, New York is the only place to be or the best place to be. I have one company that sells fashion online. Valentino is here. All the brands are here. Those are our clients. We need to be here. I have one a company that's in the music space. All the labels are here. This is the right place to be. For obviously DoubleClick and all the advertising companies, the money is here. The Yahoo ad sales force is not in Silicon Valley. It's here because that's where the money is. That's where the clients are. So there are lots of things we bring to the table that are fundamentally very, very positive and will remain so. So we're not as well placed to do semiconductors, but we are well placed to do most aspects of digital media, where it's really brain power. It's a little bit of international reach that are the core assets of any company and the ability to raise money. On the technology side, we don't have as many engineers as we would like. By the way, nowhere in the United States do you have as many as you would like. There's a huge problem across the world. As a side note, which is not New York related, the fact that I can't, or with extraordinarily difficulty, can I go and hire a brilliant engineer who lives in India or Pakistan and bring him over here and hire him, which is clearly a great thing for our economy long term if we did that. It's very, very hard to do that. So on visas, if there's one thing, there's very little I actually would like from the government to help our sector. The ability to bring in smart people when we don't produce enough computer science graduates is a huge problem here, and we'd love a change there. So one of the questions that is often asked to me, either by the Blue administration or today or other places, is what can we do to help the sector? And we being public society, the government, the city, the state. And I wish there were a lot of things that would be helpful. I think the fundamentals are very good. The answer is there's very little that can be done. I think hundreds of things that help everyday working life, which helps all of us, like the things we mentioned, schools, infrastructure, things like that. And that's helpful for everyone. But particularly for our sector, the reality is paperwork is not a big problem. Most of my companies don't make money for 4 or 5 years. So taxes are actually not as big an issue. There are some payroll taxes and things. We have vision, not profits. So long term you do need to have profits. But personal taxation is high. But for the majority of people that are working in my industry, and it doesn't represent most industries, but tend to be younger, a smallish percentage have children. They're cramming in. They want to live in New York City. Or if they don't, we can't bring them here. I talked to someone the other day in Pittsburgh for a very senior position. She has $600,000 house, which is like the size of this hotel. New York's just, it's a trade-off. Let's put it that way. So you just got to be willing to make that trade-off, and the bottom line is she's going to stay in Pittsburgh. But lots of other people are here. So one other key thing is outsourcing. Outsourcing is enormously beneficial for my industry. So most people are paranoid. They see Wall Street is outsourcing technology jobs to India, but it means that the ability to do that means, one, don't forget that there's no shortage of companies that are willing to pick up the people we're working on Wall Street in technology like my own. So those jobs are fine. Plus, if you can't find all the people you need to be able to have the smart business people based here, but create the product and have a 10-person team in Romania or somewhere else is hugely helpful. And I don't think there's a constraint now, but at various points in presidential elections, there's talk about constraining that and taking jobs. But it's for New York in particular, that ability is very, very helpful because that's a big cost structure, cost center. So overall, look, I'm extremely bullish about our sector. There are a lot of great things going on. We don't need any more help that I can really think of from the government. The sector has been booming. The whole entire sector worldwide and the United States has grown enormously in the last 10 years. I think it will continue to grow. I know from speaking, I'm a board member on the New York City Investment Fund. I feel like the biotech sector, which I'm not an expert, is one that should, over the next 10 years, be an area of focus. And I think there are a lot of things to do. There we have the people in New York City, we have the hospitals, and we do not have the businesses. So to me, it's very much where internet was 10 years ago. And so I think that's an enormous, enormous opportunity, and the sector that I've encouraged the city to invest in any way it can through the science parks and other things. Because if we get the critical mass right now, we want to be in 10 years where we are today. There's no reason why Boston has 1,000 biotech startups, and we have actually very few, whereas we've completely taken over in the digital media space from Boston in the last 10 years by being here. So with that, I feel very bullish. Thank you.
So I was fascinated by Jason Bram's presentation, and Boyd, as I'm sure everybody in the room was. But in the world of development, which is what I'm going to speak about, should that be showing up?
Yeah, it should. Just pick your hand on the touchpad.
Wrong one. Okay. In the world of development, which I'm going to be speaking about, Jason's presentation reminded me of that old joke about the man falling off the Empire State Building who, on passing the 22nd floor, looks around and says, "So far, so good." Now, in development, I'm going to start with construction activity. This is a chart from a report we put out over the summer on construction costs in New York. This was done by economist Regina Armstrong. And she used data that's from the New York Building Congress and Dodge. And essentially it shows that in the years since 2003, New York has had a steadily increasing volume of construction in all categories. So infrastructure, including transportation and public works, commercial, meaning office, retail and hotel, and residential. And the Building Congress said that one of the unusual things about this prolonged boom had been that the sectors moved together. In the past, in New York, there had been a tendency for one sector to surge ahead and another to lag. But in this case, since 2003, sectors have moved together. Now, in 2007, New York had something like $26 billion in construction activity. Just 4 years earlier, it had been $15 billion. Now, this second chart, construction spending, 1995 to 2010, is a New York Building Congress chart from a report they just put out. And this, again, actually goes to the man falling off the Empire State Building, because what the Building Congress finds is that New York's going to be in pretty good shape over the next year or so, because it's going to be living off of momentum. And then we're going to see a precipitous decline probably in 2010. By 2010, the Building Congress estimates builders will be creating only 18,500 new residential units in the 5 boroughs, nearly a 50% drop from the record 35,700 units this year. So this is also a little bit different, I think, this is a different view from David Malpas's earlier presentation, in which he said he thought the economy would hit bottom at the end of the year and then recover. The Building Congress thinks in development, something closer to the converse of that, in which we'll be living off of momentum and then see a precipitous decline. Now, construction employment, this is another Building Congress chart. They estimate that the number of construction jobs will nosedive from a peak of 130,100 this year to 100,250 in 2010. Which gets us to a fundamental issue. EJ had made the point that, the argument that we should we should use the crisis to impose or at least encourage certain reforms. This table is from our construction cost study put together by Rosemary Scanlon, and it shows the comparative costs of office construction in New York, Chicago, and Atlanta. It pretty much just speaks for itself. New York is just so extraordinarily expensive in relation to its competitors, and over the last few years in New York, we've had a tendency to think of our competitors as other world cities, and indeed that is a very serious competition, but American cities are also New York's competitors, Chicago, Boston, Atlanta, LA, and their construction costs are far lower than in New York. Here comes a very serious political issue, comparison of hourly union pay scales for selected trades. Again, this was put together by Rosemary. Now, one productive outcome of today's financial crisis will be, this is now happening, a renegotiation of a lot of deals and a lot of projects to bring costs down. I hope that there'll be a lot of activity of bringing down labor costs. A certain amount of that's going on privately. These things tend not to get publicized at all, but projects do get renegotiated. A somewhat worrying thing for the future is that during the prolonged boom, there's been a gentleman's agreement in the development industry that affordable housing would be primarily non-union labor, not exclusively, but a great deal of non-union labor builds affordable housing. That particular gentleman's agreement is now under a lot of pressure, and if those jobs that are not now union become unionized, we're going to see the costs in what's now called affordable housing shoot upward, making New York even less competitive. Increases in building costs. This is just another Rosemary chart. It's just to say that building costs have been going up all over the country and have been rising faster in Chicago and Boston than in New York, but that's of little comfort given that our costs are starting out twice as high as theirs. Now, all building that's done, of course, is done within the rules of the game set up by the city. And the most serious set of rules is zoning. Last week, Fred Siegel had a panel at Cooper Union in which he asked the question, is the city zoned properly for the future? And the answer to that is partly yes and partly no. The yes part has to do with the amazing rezonings that the Bloomberg administration has done over the last few years, really extraordinary. Bloomberg essentially increased the supply of land in New York, which is about the only way we have to bring down costs, increasing the supply. But what the Bloomberg administration didn't do is look at the fundamental zoning code from 1961 and ask, is this really productive for New York? There are many things wrong with the zoning code, many things wrong with the 5 feet of regulations that accompany the code, but I'd like to mention two. One is that the zoning code is fundamentally anti-work. It excludes work from huge sections of New York, residential neighborhoods. This is actually the antithesis of New York's historic development pattern in which jobs and commerce and industry and residences and schools and everything was mixed up together. Zoning has an underlying assumption that some uses are deleterious and should be excluded from other uses, that residential needs protection. And it certainly is true that certain residents do like protection. It's also true that many people move to New York for the kind of exuberant diversity that is New York's traditional development pattern that includes work. In other cities, there's been a very active what's called live-work movement. We don't have that in New York, which is amazing to me because it's really our development pattern that everybody else is looking at. We only have a few live-work jurisdictions in Brooklyn and Red Hook. They've been very successful. I'd certainly like to see more of that. A second fundamental problem in the zoning code is that the progressive intellectuals of the Wagner administration thought that certain uses and certain kinds of development in New York needed special protection, particularly nonprofit development, and they set up a special category community facility zoning that gets a development bump up. So if you're building a community facility, you can build a far bulkier building than if you're building a normal for-profit building, and you can see the results in the development of the medical centers on the east side, or those of you who live downtown know about NYU's very extensive bumped-up development. Columbia, the same thing, all nonprofits that do community facility try to get the bulk bump up. Now, what I'd like to see the administration do on this is take advantage of this crisis and really look at our zoning code very seriously. And with, for example, this kind of incentive, why not redirect development to areas that really need it? Which brings me to just a few photographs. 125th Street. This is a very good example of an area. I think the Bloomberg administration did the right thing here. Harlem is very underdeveloped and can take substantially more development. It's also an example, 125th Street, of the nonprofit versus profit problem. A very good project that Vornado was doing, a high-rise office tower with sports clients on the east end of 125th Street, right by the train station, is not going forward. A rather similar and actually very good nonprofit development by the Apollo Theater is going forward, and I think we should think about why is for-profit development not going forward and nonprofit development is. 125th Street. Manhattanville, you take a look at this, extraordinarily underdeveloped. This is where Columbia hopes to build its campus. That's a project that I think on the merits is unquestionably important to New York, and it should go here. It's too bad Columbia handled the politics as poorly as they did with eminent domain. But that just seems to be the history of Columbia and New York. That absent eminent domain, I think this is exactly the kind of project the city should be encouraging, and I don't even mind a community facility bump up here because the neighborhood can patently take a great deal of development. Is Brooklyn zoned properly? I took this photograph from 1 Hanson Place, the Williamsburg Bank building. I think Brooklyn is an example of miracle in New York, phenomenally successful economically, classic Brooklyn development here. Atlantic Yards, do we need it? I think this is a moment when we should really be thinking about whether or not we want to encourage massively subsidized, socialized private development. I personally think the answer is no. Thank you very much.
We have time for a few questions. Do we have a microphone in here or no? Yes, we do. Okay. I'm going to take the opportunity to ask the first question as Joe's got his hand up there, but I'm going to ask the first question. Let me ask it to Kevin. You were refreshing in saying we don't need government. I don't need government for anything, and I think that's wonderful. But I have a question in the form of 3 words. The Amazon tax. As Mike Myers used to say on Saturday Night Live, discuss.
So things like that can be an issue, and I think we don't want to do anything that is disadvantageous to the state. I mean, I think there are things like that, and I think.
Can you tell the people a little bit about the Amazon?
And I'm not an expert.
Just very briefly.
I'm not an expert. It's just a question of where state tax gets paid when you're shipping products across from one state to another, and does the recipient pay? Is it automatically charged to them? Things. There are things in e-commerce like that are very complicated. We tried to, for my e-commerce company, ship to Canada, and it's basically impossible.
Right. And the Amazon tax is something that's on the table here in New York State, and it is a disincentive to certain kinds of internet companies that would relate here. And in fact, we do know that New Jersey is beginning to pitch some of those kinds of internet companies here. It just seems like the wrong kind of thing to do in an environment like this. But now I'm editorializing. Joe?
Yeah, I agree.
Question?
Thanks, Steve. I appreciate the optimism of Professor Glaeser and of Brian. Is it Brian?
Jason,
I'm sorry. Because after this morning's 2 presentations, it's good to see that kind of level of optimism. But what was underlying this morning's presentations was a question of what do we cut and what taxes do we raise? And while your optimism never really dealt with tax policy, a little bit on the entrepreneurial side, you don't pay tax until a certain point. But isn't New York at a point where if it raises its taxes much more, Amazon being one of them, like that, or the general corporate tax, your entrepreneurial companies will leave and the financial services companies will end up in North Carolina or Florida, where because the world is flat, New York doesn't have that advantage that it once had. Can you just talk a little bit about tax policy and your optimism?
Can Ed start with elasticity? Could you want to say something in tax policy in a place like New York City?
Sure. I think you're exactly right that there certainly is a significant tax elasticity where firms will move away. And in fact, actually, you may be interested to know that in fact, Barack Obama's chief economic advisor, Austin Goolsbee, wrote his first famous paper showing, which I was the editor of, was showing that actually states with higher state income taxes saw more of a shift to e-commerce. That was actually where Austin Goolsbee made his bones. These elasticities are real. The importance, the value of being around smart people and the strength of finance has led us to ignore that. But again, I think that's one of the upsides of a downturn, right? Is that it reminds us that in fact, even in upturns, we're still losing people because of tax policy. We're still losing people because we're running a very heavy burden, and it's not free. In terms of the general expenditures are usually in terms of state and local government are the big state numbers tend to be in healthcare and schools, right? I think no one is particularly enthusiastic about cutting policing, which tends to be pretty critical. New York, of course, because it's not like most cities, also has a substantial amount of, say, public transportation budget to think very heavily about. But I don't see any way without thinking about both schools and hospitals, the schools and healthcare, that you're going to actually make real inroads into this without raising taxes. And if you ask for my view, I'd rather bet on the children than keep levels of healthcare spending up. So I believe the right response is to cut healthcare spending.
Okay, and Kevin, let me for Joe's question, let me frame it this way. Someone once said that Microsoft could have never happened in New York City. And the point they made is that at a certain tipping point, a company like Microsoft, a 20th century, would go somewhere else. Is that true of your sector? Does it matter in your sector? Or is your sector going to be nothing but a bunch of small, an accumulation of small companies?
Well, the majority of companies are smallish compared to a big Wall Street firm. But look, people always say I can't find engineers in New York. Google now has 1,000 people here. And so where were those 1,000 people 5 years ago? They were all in New York. Google's hired them. So at what point is it, could you have 25,000 people here? You probably run across it. But that's not the challenge. If firms feel like a DoubleClick, we had 500 technology people here, that you can get to several hundred, that's bigger than the vast majority of firms in the world in my sector, and can create a tremendous amount of value. So look, we always need more engineers, but I don't think that's the biggest problem. One thing I would add, though, is that I do find for senior executives, occasionally trying to move them to New York City, that they do the calculations on state tax and city tax, and it becomes a constraint. So I've had one person, it was one of the factors why they didn't want to move here, and I do know one or two people, senior execs, who wanted to move before they sold their firm so that they could go somewhere to get around that.
Right. Right, and I would note that for that Pittsburgh executive, Pennsylvania's top state tax rate is 3%. Mm. Right. Yes?
Thank you. We are talking about causes and consequences and remedies. Can we talk about prevention of the meltdown?
Prevention of a financial meltdown? Yeah. We're trying. Well, I mean, the prevention of the meltdown. If we could go back a few years, there are probably some things that might be done differently. But I have to tell you that without really, it's not an area that I'm not working on in this financial kind of markets and what's a lot of the real interesting stuff that's going on at the New York Fed. But I can tell you that there are a lot of very smart people looking at the issue, and that they're trying to stay ahead of the curve, and they're trying to say what possible downside could come if this happens, what upside could happen. So. I think prevention is important, but I think a lot of the damage, we're already in a period of financial turmoil.
If we're going to have a government policy, and we can talk about whether or not that government policy is appropriate, but if we're going to have a government policy that throws hundreds of billions of dollars to avoid the full-scale financial meltdown, then clearly the actions of the financial firms that took risks that led to that are creating externalities on the rest of us. Clearly, if taxpayers are going to be expected to pick up the bill, then some form of appropriate, relatively mild, hopefully, government regulation to limit that, to increase transparency, to make, to limit the possibility of moral hazard on the part of firms taking huge risks that other people pay the bill. Surely that is appropriate. Although, again, as I said in my speech, I'm worried that we will go too far and we will regulate the wrong things. But the idea that we are going to stop future meltdowns from happening is a non-starter, right? It's a non-starter. This industry. This industry is filled with incredibly smart people who often create huge value for the world by directing finance in the appropriate way. But they also figure out smart ways to make money that are not that productive sometimes, right? They're not angels, any more than the rest of us are. And as long as there have been financial markets, there have been bubbles, and there have been meltdowns, and the right approach for New York is to understand that this will be part of our story as a city as long as we continue to house financial services here, and that's something that we can live with.
I would also just add that our entire first session this morning was on causes and possible solutions and regulations. And eventually we will have this, I believe, online the entire day. And so you can go back and listen to that first session. Joe Rose back there? I have a feeling this is going to be a development question.
Well, just a question to Julia. You stated that one of the problems, core problems in the zoning resolution is the hostility to work, and then you called out as a problematic provision the community facility provisions of the zoning that are one of the few areas of the zoning resolution that welcome or invite work-related activity in residential areas in terms of encouraging institutional investment and development, educational, healthcare facilities, and the like. And I'm just wondering if you could talk about some of the tension there, because that's the problem. Every time you have an area where you do invite growth into non-traditional areas, you bump up against countervailing forces.
Yeah, that's really an extremely good point. What clearly happens with these these subsidies in the zoning code is that they do exactly what they were intended to do. They encourage development adjacent to current development. And in already overdeveloped neighborhoods, I'd like to see the city do a sort of geographic 421 reform on community facility in which they stopped encouraging bulk development in already overdeveloped neighborhoods. So I'd be all for keeping the community facilities bump up if they encouraged it in neighborhoods that are now underdeveloped and that need the investment. So what's happening now is, for example, on the east side, boy, do we want any more development on the east side by those medical institutions? I think probably not. I mean, there's plenty, and by the way, what tends to happen is the work doesn't get integrated with the residences under this bonus anyway. It gets, it moves out from its original core center. So.
It is kind of strange, too, that the city that inspired Jane Jacobs to write The Death and Life of American Cities is now a city that is segregating work and other functions from each other, since, of course, that was probably the essential observation of that book that set off the entire book. Richard, over there?
Yeah, a lot of this discussion, or I'd like to bring it down to street level. I represented small business for close to 30 years in the city, and everyone's sanguine about tax policy and city services, et cetera. The mayor's increase of the commercial real estate tax in 2002, added to the regulatory policy, which has been quite austere, has created the highest level of evictions and bankruptcies at small business level than ever before. We can't afford to put a supermarket in any city neighborhood because of the cost of doing business here, and the supermarket operators, the immigrant entrepreneurs, are moving to North Carolina and Florida and opening up stores there. So the question is, how do we, and I think it comes from Joe Loda's question here, how do we reduce the cost of doing business here for less rarefied atmosphere of business development?
For those businesses that aren't premium businesses?
Yeah, I guess so. Not, the luxury items that the mayor talks about.
Anyone want to take that? Julia,
Actually, there is a small zoning point to be made here. Two small points. One is that, when the Bloomberg administration went to increase the supply of land via rezoning, it didn't pay particular attention to commercial rezoning. And so all over the city, there are neighborhoods in which commercial enterprises had been allowed to exist for a very long time that are now illegal under current zoning. For example, on the west side, there's several side streets. 84th Street is one of them that has a great deal of sort of small retail that's really, out of code with zoning. And one thing the city could do is have an effort to rezone to permit commercial in substantially more spaces than it's allowed now. And then a second, it's a minor point, but all over New York, we've got these huge public housing projects that have no retail in them. And there again, you could increase the supply of land available to commercial enterprises if you if you encouraged retail in public housing developments. And that would, of course, also be very good for the tenants who right now have no grocery stores.
Yeah, I mean, Julie's completely right on this. There really are only two ways forward, right? One of which is actually changing the explicit costs created by government, and that in the long run means reducing government expenditure, and that means eating into something like medical spending, or it means actually reducing the cost of space. And the only real way to reduce the cost of space is to build a lot more space. So unlike the one area where I differ from my esteemed colleague is I've never looked at a neighborhood in Manhattan and thought that was overdeveloped. I've always thought there's more room to build up there, and I certainly could not agree with her more. That actually making more space available will, not just make Manhattan more affordable for ordinary Americans, but will also make it more affordable for ordinary businesses to prosper in. So I'm with her 100% on that.
Well, that's all the time we have right now, and I want to thank you all and the panel.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.